They want your liquidity, and that is why you get stopped out like this. But after this video, you will know how to avoid it and get their liquidity instead. The best solution is to find high-quality entry structures. So let's get into supply and demand first. If you're a viewer of my channel, you probably already know about them. But in this video, we are going to go in depth on how to refine them. And by refining, I mean that we increase their quality. A higher quality supply and demand is harder to find because it takes longer to identify, and also are met more rarely than lower quality supply and demand zones. So let's explain how this is done. So obviously we already need to know basic and also advanced market structure, because the problem of low quality demands like this one is that traders just get into the charts, and they understand the theory of supply and demand zones, so the demand being the last downside candle before the upwards movement, and the supply being the last upside movement before the downwards movement. But then if you only know this theory, that doesn't mean that is enough, because as you've seen, the market could just break each zone and not give you even a tiny chance to respect it. So one way to avoid this is to first understand the trend the market is following on the external structure, and now get into the very important concept that adds up, and that is the external price action and the internal price action. The external price action is the movement of the market on the high time frame. For example, let's say that this is the 1 hour time frame that follows an uptrend. We would see something like this: higher highs and higher lows. But if we were to zoom into a lower time frame, this whole movement is still the same. But now we are able to also see the internal price action. So, if the external price action shows one upwards impulse, the internal price action would show multiple higher highs and higher lows inside the lower time frame. And the pullback on an external price action is simply seen just like a straight downwards movement, but on the internal structure is seen with multiple formations of lower highs and lower lows. And now there is two more things that we need to know, which are the break of structure and the market structure shift. When a market is following an uptrend and it breaks its past high, we form a bullish break of structure. This just shows that it has broken out of a price level, and after a break of structure, it's often meant for the market to enter a pullback phase, which, on an uptrend, the pullback is downwards movement. And as long as the market keeps printing higher highs and higher lows, we will have multiple formations of bullish breaks of structure. And when it stops to do so, and the market breaks down below the last low, we have what is called a bearish market structure shift. And this just signals that the market has a high chance of reversing back down, but this is validated only if the price pulls back up and fails to break the last high, and then instead it moves down again below the lows. So usually traders would look to sell near the first swing failure or near the second one. Now if you already knew this, because I've talked about this on my previous videos, it's perfect, because we also have something that is called internal break of structure, an internal market structure shift. So let's see this move how it's seen on a lower time frame as well. The same theory applies. On the external price action, the market goes straight up to form the high. On the internal price action is seen with movements that form higher highs and higher lows, and after each break of internal high, we get an internal break of structure. But now when the market pulls back externally, to continue the external trend eventually to the upside, the traders that were on the lower time frame see an internal market structure shift towards the bearish side. So basically they see the market as being bearish, so they look to sell short the market. But the problem is that the market is still following an uptrend. And this often ends with the market filling their sell short structure, which is probably a supply zone. But then the market breaks above the supply, stopping them out. And all of this has happened because they've traded in validated supply zones. And they did not respect time frame priority, which in most cases the higher time frame price action has priority over the lower time frame one. The external or higher time frame price action is used to identify the trend that we are following, and the low time frame or internal price action is used to identify a setup. But that setup needs to align with the higher time frame trend, else we are trading against the market momentum, which makes these setups extremely difficult. So the way to actually look at this is to view the internal market structure shift as the first indication that the higher time frame will enter a pullback phase. So after the structure shift, we look for a high time frame demand zone, but on the external price action. And as you know, the demand zone should be near the last swing higher lows. And now what we want to do is to simply just wait for the market to come back into the demand. So externally we will see a straight down movement, but internally we will see multiple formations of lower lows and lower highs. So basically a downtrend formation. And if the market hits the demand, we switch into a lower time frame. And on this lower time frame, we want to see an internal market structure shift to the bullish side. So basically, we want to see the market breaking above the previous internal lower high. And this in itself forms an internal higher high. And after this happens, we look again for a demand zone, but this time on this certain lower time frame. And this is how you refine the setup. This is how to increase the quality of a setup closest to its highest potential. And now, jump into a real live chart example. So let's take a look at the first setup, starting from a Forex pair. This works on every market, by the way, so we will also look at futures indices, Forex, even commodities like gold. So let's take a look at this market. Initially, it started with a more slow uptrend, sort of an uptrend that is visible that it's losing buying strength because it's forming higher highs, which is expected, but at the same time it's also forming equal lows and also lower lows, which is not a good sign for buyers. And it has managed to push into new highs lastly, but then it was shortly lived because a massive bearish momentum started picking up and eventually breaking down below the last swing low. So having a lower low formed on the external price action, this means that we have a bearish market structure shift, of course on the high time frame trend. So basically the high time frame has reversed into a downtrend at this point. Now when we got a high and then an instant downside reaction that breaks the last lows, this is just a simple downtrend price structure. But because of the confirmed market structure shift, we can look for supply zones to sell from. The first supply would be here, which happened right before the breakdown of the lows. But it did not fill since sellers were so strong they did not give a single chance to buyers for any significant pullback. But instead, we got this very small pullback, from where the market prints the same type of price action once again, basically forming high, then aggressively breaking down below the lows. So again, it validates a supply zone, and this supply has actually worked. Notice how the price pulled back up into the supply and rejected it. Also, do not forget to mark the breaks of structure, which happen on downtrends when the price breaks down below the previous structural lows. Now what we would expect on the bearish case is for the market to pull back to and form a lower high, then a lower low, and so on. But this time, that did not happen, and buyers finally came into the market, pushing up the price higher and eventually breaking up above the last swing high. So when the market breaks above the last swing high in a downtrend, we got the bullish market structure shift. And because this is done on the higher time frame, and specifically on the swing levels, this shows that the high time frame trend has a high chance of reversing into an uptrend. And there is a demand zone right at the bottom. But the market practically continued the uptrend and formed a new one above, which is close to the break. And eventually the demand got filled. Now we would want to zoom into a lower time frame. Because we already are inside of the demand, I will actually zoom into the lowest time frame we can so we can watch every move in detail. So this is the 1 minute time frame, with the price being inside of the high time frame demand. So far, a pretty bearish momentum. And here we finally got a bullish move, which breaks above the last internal high, which forms an internal market structure shift towards the bullish side. Now what we would want is the market to pull back down and confirm the reversal, which eventually it did by breaking into new internal highs and forming the first internal bullish break of structure. Now that the internal trend has validated and confirmed a low time frame uptrend, we can look for a pullback where we look for a demand zone to take the market into the highs. And the last structural internal demand is situated right there. This is the low time frame demand where we will actually trade from. So placing the buy setup, stop loss below the recent lows, and take profit above the highs. So it has a 1 to 2, 1 to 3, or 1 to 4 risk to reward. We can also move the stop loss slightly lower to make sure the spread does not stop the position out. And the demand did not fill, and it has formed another structural level. Keep in mind that most demands and most supplies will not fill. You just need to get that one that fills and is also a high-quality one, and since we are refining the setup so much, it's actually expected to have fewer zones that will open trades. But anyway, it moved into new highs, forming another internal bullish break of structure, so it has still held similar expectations of higher highs and higher lows. The thing that changed is that it has formed a new demand right up here, and the same planning once again. And finally, there it is. See how the demand got filled and rapidly reacted with buyers coming into the market, and of course driving the market to the upside. But what if the overall higher timeframe trend is following a downtrend? Well, that is simply seen when a market has its external price action forming swing lower highs and swing lower lows. But this is, of course, on the high timeframe. But this price action on the internal structure, so on the lower timeframes, is seen like this. So this entire straight down movement is formed with multiple lower lows and lower highs. And after each downside breaks, we get an internal bearish break of structure. And eventually the market will start a pullback to the upside, because the market won't just go down forever. And that move is seen on the low time frame with the price breaking up above the last internal high. So traders think that this market is about to reverse. And they might be right, but on the low time frame. And what they look to do is to buy a demand and hope the market goes up. And most of the times it actually goes up, but also most of the times it comes back down into the stop loss. So this happens because these traders did not respect the external trend. All of this move is not an external reversal, but it's just a pullback to rebalance the market, which sometimes fill a high time frame supply zone. And that is what we actually want to see. And when the market fills the supply, we zoom into the lower time frame, and now we do exactly that the losing traders did before, but to the opposite side. So of course the pullback is seen as an internal uptrend that forms higher highs and higher lows. But eventually, if it rejects from the high time frame supply, the low time frame price action will break down below its last internal lows. And this forms an internal bearish market structure shift. And it's now when we look for a low time frame supply zone to plan the sell position, the whole plan and idea is not trying to predict a breakout, but just following the external trend. And if the external trend is bearish, well then we look towards sell setups. And now let's try this on the charts. Starting from the beginning of the chart, which is a swing high from where the market pushes back down, and then we enter into an internal uptrend, which is simply just an external pullback. This internal uptrend is of course formed with internal higher highs and internal higher lows. And on the next movement we see a similar price action, and on the next one as well, seen with this upwards movement formed with multiple bullish candles, this forming the internal highs, followed with a small and quick downwards pullback, which forms the internal higher low, and again an internal higher high. But now we see that the market has broken back down, and it has formed an internal lower low, while also breaking down below the last higher low, which forms the market structure shift internally. Now some don't consider this as a pullback because it might be too small of a move, and in that case the market structure shift would be lower down here, but it doesn't change much, because we expect a pullback after any structure break anyway. And we've got the pullback seen with a lower high internally. Now usually the market would have had to form internal lower lows and internal lower highs to eventually move down and break all of recent swing lows, so that way the market would continue the downtrend. But in this case, we've actually got a reversal. And if that was your plan, well, that would have been a losing trade. But there's not a big problem. Feel free to watch my last 2 videos on how to actually trade reversals like this one. But now we're going to focus on this video and specifically on this chart, because the market is losing selling strength, and instead, the buyers are gaining strength. Notice new formations of higher lows internally, while also being followed with higher highs, to later just form this kind of sideways price action from where the sellers started coming back in again. And this whole bearish price action breaks down below the last higher low. But this time, being on the external structure, we don't have an internal shift. We actually have an external shift since this is done on the swing or extreme levels. And on the last price movements that we can see, the market looks very bearish, so following the trend would mean that we would look for selling opportunities to follow this recently formed external downtrend. And for sell setups, I usually use supply zones. The supply is the last candle before the downwards impulse, which would be this candle entire zone. But remember, this is the high time frame supply. We now want to switch into a lower time frame, let's say the 5 minutes one. In the 5-minute chart, we've got the larger downside move that we've seen before, but now it's looking like the market is entering a pullback phase to the upside. And now it finally hit the supply. So basically, after printing that large bearish move, we started to pull back to the upside and forming higher lows. and higher highs. This is on the internal level, so eventually for a sell position, we want to see a breakout of the internal lows to form an internal bearish market structure shift, followed by a pullback where we will look for another supply, but on this certain low time frame. We got one more higher high and higher low, and now we're seeing swing failure. And we also got the break of the internal lows right here. So basically, this is the market structure shift internally. Now we look for the closest supply to the shift itself, and it should be at this level. It's exactly at the current price at this moment. So opening the sell position, with the stop loss above the recent highs, the take profit usually we would have placed it below the structural lows, because we would expect a bearish break of structure on external or higher time frame trend. But because this is a way too high risk to reward ratio, I will look for a more realistic and safer one. A 1-to-4 would be a great spot. And right after hitting the low time frame supply, the market started this very bearish pressure to the downside. This moved even lower, so risk seekers got more out of this position, but I say it once again, be careful to not be too greedy. Into another example, this time choosing the 1-hour time frame as the main one on the Nasdaq. Now if we move back, we can see that this market has been very bearish for quite some time, and if you notice, a very similar price action has been repeating over and over again. So it's something like this: a very aggressive downside movement, followed by a small upside pullback that takes quite a long time. Then when the price approaches the last swing high, it starts dumping aggressively once again. And basically the same type of price action again and again. But the good news is that this is quite simple to trade. All we need to do is to identify valid supply zones near the highs. This is usually how we trade this type of price action. And now let's apply it on the charts. Now here is a supply, but the price did not move there and instead continued the downtrend. So the sellers were so strong that it didn't even pull back to the upside. And of course, if the market pushes down and manages to break below the past external swing low, well, in this case, we get a bearish break of structure on the high time frame. And as shown on the line presentation, the market prints a similar price action. So basically a straight downside movement, followed by a pullback, and again an aggressive downside move. Move that breaks once again below the last swing lows. So we got the bearish break of structure on the external price action. This break validates a supply. But this supply also did not fill. Do not worry if there are a lot of supplies or demands that do not fill, because it's actually expected to do so. Most should not fill, and it's only a few ones that fill, and that are also valid. But that isn't a problem, because in best case scenario, you just don't have a position to open in that moment. And even if you would lose in the worst case scenario, you need few wins to cover the losses if you're trading with a decently high risk to reward, not too high but also not too small. So anyway, coming back into this chart analysis, the last supply did not fill, and the market continued with an upwards pullback and another break of the lows, which of course leaves us with a new bearish break of structure, and the same kind of price action happened on the latest movements. And from the last downwards impulse, we also look for a supply, and there is the supply. Now we just wait for the market to approach the supply. Here the supply got filled. We now switch into a lower time frame, the 5 minutes in this instance. On this time frame, the internal price action has formed internal higher highs, with internal higher lows, but the market did not break below the last lows, so we do not have a lower time frame supply yet. So we just wait for the market to break an internal low. Here we got an upside continuation, so a bullish internal break of structure. After a break of structure, we expect a pullback phase, and then we see if the market forms a lower high. That means we get a swing failure, and in that case, we would look for a breakdown of the last internal lows. Or if the market continues the upside momentum and breaks structure into a new high. And the first scenario played out, with the price breaking down below the last internal low. So this is the internal bearish market structure shift. And the expectations after an internal shift would be for the trend to start forming lower highs and lower lows. So in that case, we would look for a supply here in the low time frame. And that would be this one, being the last upside move right before the impulse. And now we can plan the setup. Sell on the supply, stop loss above the recent internal highs, and take profit can be placed below these last internal lows. depending on your risk management. The risk-reward can be decent to a 1 to 3, 1 to 5, or even below the last swing low since we expect a break of structure on the higher time frame. But in that case, we would have a very high risk to reward, which in some cases can be dangerous. I usually take 1 to 3, or 1 to 4. But this time, let's go a bit more crazy. So the position gets triggered, and soon after it fills the position, the market starts selling off pretty significantly, and eventually closes with a win. Now this might look slightly complicated, but it's how we can get the highest quality supply and demand zones. I also go in detail on my trading program, where you can find it on the link in the description. I focus heavily on building a system using these strategies, and most importantly sustaining profitability, because becoming profitable is not the hard part. The hard part is actually sustaining it. So anyway, thank you for watching.